Okay, hi everyone, Daryl here. Okay, so this is lesson 45 in my YouTube playlist Investing 101, and today we're going to talk about hedge funds. Okay, so a lot of people actually don't quite know what are hedge funds, and they actually, because of the size and because of the things that they invest, they actually tend to be able to move markets. So I'm not actually asking people to invest in hedge funds, but I want to let people know that these are actually players in the market, and therefore, private investors or like individual investors like ourselves, we don't have the financial capacity or capability to actually influence the markets, and these are the people who have an influence on the market. So if let's say a hedge fund does something right, then if it's a substantially large hedge fund, it can actually cause some price movement in the market. Okay, so what are hedge funds? Hedge funds are typically, they are private investment funds. A hedge fund is a private investment fund, usually for wealthy investors. So there are certain financial requirements which you have to have before you can invest in hedge funds. So those who do not meet the financial requirements cannot invest in hedge funds. And these, because there is a financial requirement, so therefore generally hedge funds are only for wealthy investors. And these wealthy investors are deemed to be more financially savvy. Therefore, normally, those financial regulators, right, they have usually less oversight for hedge funds, which means that they have less disclosure requirements. They need to follow maybe their prospectus, and their prospectus may not be so comprehensive. They can privately pool money without the investor going through like a risk analysis, something like that. Okay, so because we are wealthy investors, those who have money, right, they are deemed to be like, they are able to understand all these things without the need for the government to protect them. Yeah, so there's usually less oversight, okay, by the government, by the financial regulators. Okay, and what was the initial idea of hedge funds? So the hedge funds, they are called hedge funds because the initial idea was to hedge an investor's risk. So investors were supposed to be protected during downturns in the market while obtaining higher than above returns due to professional management. So normally there's a hedge fund manager, right? So he'll be quite financially savvy. He's very good at investing. Then he will actually ask investors to put money together so that uh, he knows how to be defensive in times of downturn. Then when it's an upturn, he will know what to do so that he can better obtain good returns for your monies. Okay, so the definition does not hold in today's context. What happens is that uh, nowadays hedge funds are now risk-seeking investment funds. They try to maximize returns, and hedge funds also leverage to try to magnify these returns. So to actually amplify the effect, the gains, right? They try to borrow money, use leverage, but then of course this also causes them to lose more than the amount that they have if they seek risky returns, and then these risky returns don't pan out in the way that they initially thought that they would pan out. Okay, so normally hedge funds, right, they include these fees called management fees and the performance fees. So to manage the money, typically they'll take a percentage of the asset under management. So maybe if it's like, I'm just saying a typical number, maybe like 100 million, then their management fees maybe 0.5% of the funds under management for a year. And then performance fees are things whereby if let's say it's a hedge fund, from 100 million, the hedge fund manager manages to make the 100 million become 120 million. So maybe he is entitled to maybe 10% of the gains. So he's entitled to 10% of that 20 million profit. Okay. Sometimes they may have a hurdle rate, which means that the hedge fund has to clear a certain hurdle rate before the hedge fund is actually paid performance fee. So maybe the hurdle rate is, example, maybe like 10%. So the hedge fund has to make money more than 10%. Then anything above this 10% profit, right, they will be paid performance fee. So if it's 120 million, right? 100 million become 120 million, and let's say there's a hurdle rate whereby the hedge fund has to make 10%, then they will not share the performance fees of the profit 20 million. They will share 10 million only because they need to pay the first 10 million to the investor. So that's a hurdle rate. Okay, so you can actually see how excessive risk taking may drive a hedge fund's direction. If let's say you gain more profit, okay, so if you profit more, you make more gains, then performance fees are actually higher. So you can see that the incentive for a hedge fund manager is to actually try to maximize the returns. So the only way to maximize returns is, of course, to take on some excessive risk, more risk. Okay, and then of course when he's actually in the market investing, right, he's not actually investing with his own money. He's investing with investors' money. So if investors lose money, he doesn't really have to come up with because it's not his money. Then, but if the investors make money, right, his personal wealth is also, you know, he also appreciates his personal wealth because he's paid performance fee. So the fund manager has an incentive. Okay, so there are many types of hedge funds investing in just about anything, and so not typically when people say, "Oh, um, you know, I want to, the way that I think may be able to affect the stock market or whatever market," then I would always tell them that there are bigger boys out there, and one of the bigger boys are actually hedge funds. Yeah, so this is just a short explanation of what hedge funds are, and that's all from me. And I'll see you in the next video.